Hello traders, welcome to my channel. Today we are going to look at a very important and crucial topic in trading, if not the most important, which is draw on liquidity. We also dive deep into the use of fair value gaps and look at how fair value gaps can help us in a better understanding of our draw on liquidity, whether they are being respected or being disrespected. I will advise you as a trader who is seeking knowledge in trading to stick to this video to the end, because at the end of this video you will be able to master how to effectively and accurately predict the market movement using draw on liquidity and the information on fair value gap, whether they are being respected or being disrespected. So what is liquidity? Liquidity is an availability of buy and sell orders at a certain price level. So in essence, the market is fueled by liquidity. Any movement you see in the market is not random. The market is always seeking for liquidity. Liquidity is the heartbeat of the market. It is what fuels the market. Without liquidity, there is no price move. So for you to master or draw on liquidity, you must be familiar with some basic liquidity concepts like liquidity pools, liquidity sweeps, external range liquidity, your internal range liquidity, and your market structure. If you are not familiar with these, I will first of all advise you to go and watch my liquidity series and other video to master this before we dive into the main topic of today, which is draw on liquidity. So let's take a look at this diagram here. This is a price action. So let's basically look at this to explain how our draw on liquidity works. Market started from this place and make a push towards this area. It created a high here and we have a pullback to this range. Let's assume this is our area of interest, like a fair value gap or equilibrium level. Market always seeks liquidity. When market comes to this level, it needs to rebalance. Market comes down to rebalance the inefficiency. When market rebalances to inefficiency, market has to again move to take liquidity. So the market is actually hunting the liquidity. It is actually going for where a large pool of orders are placed. So when price rebalances to inefficiency here, the next draw on liquidity will be the next swing points. With this kind of scenario, we have price reach out to high and we have a pullback here. During that pullback, price retraces and failed to take out this high. When price failed to take out this high, this area becomes a failure swings and price moved down to take this low. What we are having here is an internal structure in the market. Price moves to take this low, and what do we have here? We have a failure swing which created a liquidity zone. When markets failed, it still did the same thing. We have two failure swings here, which are low resistant liquidity. Failure swings are practically areas of low resistant liquidity, and price always gravitates to areas of low resistant liquidity faster. So whenever you are making or you are trying to analyze your draw on liquidity, you should always focus to spot this low resistant liquidity, because that is where the areas price are likely to go as fast as possible. So we have a low resistant liquidity here. Price is likely to gravitate here. When you see price rebalances the inefficiency here, you see price gravitate to take all those liquidity. We have a pullback here and we have an impulse move. This impulse move resulted to price taking this high here, and we have a break of structure. Price continue its move. When price is moving, price is creating liquidity areas to be round. At the later in time, price will come back to run all these liquidities. And when price is moving, price is creating areas of low resistance liquidity to be run. So we see price moving and breaking structure to this point. So as you can see, this is a dynamic liquidity here, trend line here, and we have low resistance liquidity points. At the time, we have a sweep and we have market come down to take all this. So actually, market moves from external range to internal. When market moves, it seeks to rebalances the inefficiency, and when market rebalances to the inefficiency, it gravitates and take the external range liquidity. The market moves to take all this liquidity here, and here we have a sweep, not a valid break of structure. We see market come back, take this liquidity here. Then we have our major market structure shift. When we have a major market structure shift to the downside, market comes to this point to fill an imbalance before it gravitates downwards. So in other words, let us try to analyze this based on our draw on liquidity. When price moves with a big momentum and creates an areas of imbalance, typically we will expect price to retrace to equilibrium level to fill up all those imbalance. When price rebalance to inefficiency and there is no more liquidity here, price targets another liquidity. And which zone will price target? Price will target the next area where we have bulk liquidity resting. Price will target here. First of all, we have areas of low resistance liquidity, which should be our primary target. Price will first of all take this level before it goes on to take this area. When you are making your analysis, always focus on these areas of low resistance liquidity for your profit target, because sometimes price can move on to take all this liquidity and fail to reach up for this high. That is why it is very, very important to always set your profit target using your entry time frame. When market comes to this point and take this area, and we have some area of rebalance here, when market rebalances here, our next draw on liquidity is this upside. That is what market gives to it. In this area, we have a sweep, we have market come and sweep this liquidity. Actually, a liquidity sweep is a stop hunt. Most times, it signals a reversal of a trend. Whenever we see this kind of liquidity sweep, we can wait for further confirmation to know if the trend will continue or if we're likely to have a reversal in the trend. That is what happened here, and we have a reversal in the trend. And when market take out this protected low here, it came back to rebalance the inefficiency of this impulse move. So whenever you see this, your net draw on liquidity will be the inefficiency here. And when market comes down to fill the inefficiency, your draw on liquidity will be the external range. A very important question you need to ask yourself when making your analysis is, why will price move to this level? You have market at this point came down to this range. Question you should ask yourself is that, why is this price moving? Why will price continue this area and not down here? One, price moves to hunt liquidity. Another is price moves to generate liquidity. The third is to rebalance inefficiency. The fourth one is price moves to rebalance equilibrium. Price will always move to rebalance equilibrium of the price range. When a market is moving to this direction and we have price coming down to this area, what price is doing here is price is generating liquidity to be run. When all this liquidity are generated, price moves down to rebalance inefficiency here and rebalance to equilibrium. When we have a rebalance here and price has filled this imbalance, we will have price navigate to the next liquidity zone, which is to fill those liquidity that it has generated. So it is very easy to build your draw on liquidity based on this concept. When you ask yourself, price has moved and taken a liquidity here, then price has moved to and generated liquidity here and rebalance to inefficiency here. What is the next action? The next action of price is to go and hunt all those liquidity that it has generated. So let's go and look at a very important aspect to properly and accurately predict our draw on liquidity. Because yes, you know that probably that market is drawing to this area. Market has made a high here, and you know that your next draw on liquidity will be here. And when market comes, there is a possibility that market may break that level and move down to target the next draw on liquidity, changing the momentum and the direction of the trend. Price mustn't come to this place and rebalance inefficiency and seek another liquidity in the opposite direction. Price may come and break that your area of interest moves down. If you are a trader who is anticipating to enter from this area of interest and maybe you don't understand it properly, you will get liquidated from the market. So that brings us to the issue of imbalance, popularly known as fair value gap. So what is a fair value gap? A fair value gap occurs when there is a imbalance between buyers and sellers, leaving a gap in the price. So typically, when you have a fair value gap, price normally comes back to fill that imbalance. Then use that area as a support or as a resistance level to continue in its original price direction. Here, for instance, we have price in a bullish trend, and when price is moving bullish, it created an area of imbalance here in the form of fair value gap. Price came down, fill that imbalance area, fill that fair value gap, and price on. The same thing applies to the bearish scenario. Price come back, fill this fair value gap. After price fill this fair value gap, price push down and continue in its direction. Whenever you are making your analysis based on draw on your liquidity, you have to bear in mind fair value gaps can be respected and can be disrespected. So typically when we are in a bullish market, we can see price creating an area of imbalance with impulsive moves. We always wait for price to retrace back to the area of inefficiency, and we always expect that fair value gap to hold and for price to continue upwards after it has mitigated into that fair value gap. Assuming this is a higher time frame area of interest and price moves mitigate this fair value gap, we expect the price to continue in the same direction. So when price came here, it moved down. We have price mitigate this fair value gap and price continue in the same direction. We can practically say that this is a respected bullish fair value gap. The same thing applies in the bearish scenario. Price is bearish, our order flow is bearish. We have fair value gap being created. Price return, mitigate that fair value gap, and we have price push down. We can say that this bearish fair value gap has been respected. Let's say that you are in a bearish market and you have your fair value gap as your area of interest. And what are you expecting? You are expecting price to come into this fair value gap. Then you are expecting price to push down to that direction. Unfortunately, you see price move past that fair value gap and closes above that fair value gap. What does this signify? This often signals that liquidity is being drawn to the opposite direction. A disrespected fair value gap can reveal a shift in market structure, showing that the current bias is no longer valid. That is why it is very, very important to analyze fair value gap in the sense of the ones that are respected and the ones that are disrespected. In this case, this fair value gap was not respected. We see price push past this fair value gap. When price push past this fair value gap, we will likely wait for price to come back into this fair value gap to confirm possibly our shift in market sentiment. And when price came back to this fair value gap, and this fair value gap acted as a support for that price to move up, we can then regard that fair value gap as an inverse fair value gap. And this automatically tells you that there is a shift in momentum in the trend. So that is why it is very, very important in most cases to trade based on the inverse fair value gap. So let's look at the bullish scenario of a disrespected bullish fair value gap. We are in a bullish trade and we have our fair value gap here. So we are possibly waiting for price to come down to our fair value gap so that we will take our entry from here. And when price came to that fair value gap, then we see price move with big momentum past that fair value gap. This fair value gap is now being disrespected. Automatically, we can say that the momentum of the price is shifting at the moment. When price returns to that area of interest as an inverse fair value gap, and we can see we have price move up but closes inside this inverse fair value gap. So we have price move down and respect this inverse fair value gap. We can now say that this market is likely shifting momentum. Assuming my draw on liquidity is here, I'm targeting this draw on liquidity, and as I see this fair value gap being disrespected here, then I won't participate in that trade. I need to wait for further confirmation to show me that my bias is still being bullish. For example, I'm in a trade and I see that my bullish fair value gap has been disrespected and price move past that fair value gap. If I'm to still target my draw on liquidity on the buy side, I still have to see bearish fair value gap being disrespected. In this case here, we have a bearish fair value gap here. Let's say we have a very bearish fair value gap here. If this bearish fair value gap has been disrespected and this inverse fair value gap couldn't hold the price, this bearish fair value gap, assuming price push past and return and mitigate that fair value gap, turning the bearish fair value gap into an inverse, then I can say that my draw on liquidity is still here. I will give a practical chart example on how you can apply these concepts. But the point you should know is that whenever you are trying to make your draw on liquidity, always focus on the fair value gaps that are respected, the ones that are disrespected. With that, you can know when your draw on liquidity is valid or when your draw on liquidity is no longer valid. So let's go to the chart and see how we can apply this concept and use it to accurately predict our draw on liquidity. This is our bigger time frame. As you can see from this chart here, we are practically in a major uptrend. So our order flow is bullish and we are likely targeting to buy into this market. But let's see what price does and if we can really say that this bullish market is holding. For now, we have a break of structure here and the market is still bullish. So possibly, let's see if we have a fair value gap here. No, we don't have a fair value gap here. So let's see how this price action goes. It's likely we have a high putting here. It's likely we have a high putting here and we have markets come and sweep this high. And likely we are having a valid pullback into the range. So let's use our Fibonacci tool and possibly mark out our area of interest. So price normally retraces to equilibrium. Equilibrium of a range can be a valid pullback. Price pulls to equilibrium whether there is a fair value gap there or there is no. Price pulls down to equilibrium. So let's mark out this equilibrium, which is from our 50% level. Like I normally mark out from 50% level to the 79% level. Why do I normally use the 79% level? Normally, when I see a fair value gap that are within this range of 50% to 79% level, if price fail to hold that area and breaks down this 79% level, I'll definitely have to wait to see if the opposite fair value gap that was created here is respected or disrespected before I will take any position. If I see that this opposite fair value gap that has been created is being respected, is a sign that the price is shifting momentum to the opposite direction. So these areas from 50% level to 79% level is a very important range in Fibonacci sequence. So that is why I normally use those areas. I will switch to my medium time frame to possibly see what is happening there. But before then, we have areas of low resistant liquidity here. We also have liquidity resting here, and we have our protected low here. This is our protected low here. So we are practically waiting for price to enter this area of interest before we can know what to do. This is not the finest price action, but I want to use this to give a solid observation draw on liquidity and make a profitable trade. As you can see here, we are in the medium time frame. We have liquidity resting here in all these areas. So we'll actually wait for price to enter this range. Then from here, we can see if we can be able to get an entry. Price enter this range. So let's switch to a lower time frame to know if we can get an entry. You can see price traded into that block, and we are still seeing price making that down push with heavy momentum. So let's play price once more. We can see that price has come here and have a push. Let's mark out this low. Let's mark out this low here. Let's see if price will definitely respect this. As you can see, price disrespected this fair value gap. When price disrespected this fair value gap, this is a sign of price not even going to respect it. Because whatever you are seeing in a lower time frame is a smaller picture of what might happen in the bigger time frame. Because price action in every time frame is fractal. So let's see if we can have price come down and possibly negate this fair value gap here. Then we can confirm that price may definitely come back and take this range. You know, we have liquidity resting below this level here. So our area of interest is still this box here. Let's see what happens if price would respect this bearish fair value gap, and or if price this bullish fair value gap will turn as an inverse fair value gap, because we have a fair value gap overlapping another fair value gap, which is a very strong momentum signal of a bearish move. So let's see what happens. As you can see, price did not even come back into that range, but we have a very strong push downwards. We have price automatically break our area of interest here, and price is moving downwards. Price is moving downwards, and price has almost taken this level here. So what are we going to do? So since price is doing this, let's go back to our bigger time frame. If we go back to our bigger time frame, what are we going to do? We are going to basically watch if all these big fair value gaps are being respected or disrespected. So we are going to build our bias based on that. We are going to build our draw on liquidity based on that. So if we notice that a fair value gap is not respected, it's being disrespected, automatically the area that is being respected become our bias. So let's look at that. So this is our bigger time frame. So let's see, as we know, price has taken out this range, price has swept this range, and we have our fair value gap around here. Price should close straight below this level. Automatically, we can say that price is shifting momentum, but let's see what is going to happen in the market. As you can see, price has closed, swept this area and closed a little bit. So let's see price will create a fair value gap, and let's see how it goes. Automatically, price created another fair value gap here. So we are actually waiting for price to trade into this fair value gap. And if price trade into this fair value gap, what we are going to then look for is whether this fair value gap here is being respected or is disrespected. If we are going to build our bias where price will likely go to, where we take our position, we would like to know if this fair value gap here will be respected or will be disrespected. For now, our draw on liquidity should be this area, but we don't know yet because for now price might still come down, but since this is an extended price leg, price is likely to be drawn to fill all these imbalances. So let's see what will definitely happen in the price movement. As you can see here, price did not respect this fair value gap. Price did not respect this fair value gap here. So practically I'm still changing my order flow to bullish. So my draw on liquidity will still be bullish. My draw on liquidity will still be bullish. I will have to switch to my lower time frame to establish my entry. Meanwhile, in this fair value gap here, I'm expecting this area to be an inverse. I'm expecting price to come down to this area, fill up this fair value gap, and use it as an inverse. So let me see what is going to happen here. Let's switch to a lower time frame to know whether we can establish an entry point from there. This is our medium time frame. As you can see, price has zoom out from this place and is actually targeting the second fair value gap in this range. So let's see if there will be a pullback in this fair value gap so that we can switch to our entry time frame to make our entry. As you can see, price is pulling back inside this range. We have another block here. So let's switch to our entry time frame to see if this PD array is going to be respected or disrespected. So when we move to our lower time frame, what are we going to look at here? If we look at here, we will see our failure points here, which are liquidity points, which are these areas are liquidity areas that is inside the second fair value gap of the bigger time frame. So we will see if we can get an entry from here. As you can see, we have price come and take all this liquidity here. So likely our next draw on liquidity will be all these areas, but we don't have a clear entry here. So let's play price to see what definitely happens here. As we can see, price has taken this liquidity, but we couldn't enter this trade because normally I wait for a clear turtle soup before I start my trade. Here might be the turtle soup. We see this place and price putting a low, but this is not the kind of trade I enter. I wait for price to come down like this, give me this leg, then put in this leg, and I wait for a sweep like this, then a move. This is the kind of price action I trade. So it's not that clear to me, so I did not trade it. But if you are looking at it from some other direction, we have price take out this area of liquidity, and when price take out this area of liquidity, your net draw on liquidity will be here. And the validation would have been if I have seen a bearish fair value gap that has been disrespected here, and I can use the inverse to make my entry. So, but I saw none of that. Even if price moved to the intended direction, I could not have entered that market because I always wait for high probability trades to happen before I take my trade. So let's see if we can still spot another opportunity using this scenario. So I'm back on my bigger time frame. Possibly I'm still waiting to see if I can still spot another opportunity to trade. We have price disrespected this fair value gap, and we have another fair value gap which is on a 50% level of this range. So let's see if price will disrespect this fair value gap, and if price disrespect this fair value gap, I will still be bullish. I will wait for price to come back to it, then I'll find my entry and I will trade on the buy side. As you can see, price has disrespected this fair value gap, so I will switch to my medium time frame to know if I can find some other areas of entry and wait for the price to come back inside that range before I will know the best area to buy from my entry time frame. This is our medium time frame. We have an area of imbalance here, a small fair value gap here. Let's see if price will come back to this range. If price should come back to this range, possibly we will look for a buy signal. We will look for a buy signal and target. As you can see, we created another fair value gap here on the medium time frame. I always look for what is respected and what is disrespected. I fail to and plot from this range to this range. You can see that price has taken out this level of 79%. This level, when price takes it out, if price should respect all this fair value gap here or possibly returns and this fair value gap of the bigger time frame become the inverse, I will definitely look for a buy. So let's say if price come back into this range, into this fair value gap here. Remember, we have another fair value gaps here and the median time frame, but our interest lies if price should respect this. Even if this fair value gap, even if price comes respect this fair value gap here, and price did not take this fair value gap, our bias will be bullish. So let's see how it goes. Price has moved down into this range, and we have areas of low resistance liquidity here and here. We now look if price will respect this fair value gap and push up. So before that, we have to move to our entry time frame. We see that price has taken liquidity here and move inside this fair value gap to rebalance. Then our next draw on liquidity will be this area. But price can still fall down and move into this range. So, but we don't know yet. You have to be sure. That is why you have to look for fair value gaps that are respected or being disrespected. You have to be patient in your analysis. You have to be patient and get your analysis right. So let's move to our entry time frame to possibly know what is going on there and see if we can spot an entry after price has shown us that this fair value gap has been respected. If price fail to respect this fair value gap and move down, then we will likely target to sell from this position. This is our lower time frame. As you can see here, we have almost relative equal highs here, which is a target for liquidity. As you can see, price has moved down and take all these liquidity areas. And we have a fair value gap here, and we'll possibly wait for price to move and break this fair value gap, possibly with momentum. Then if price can break out of this range and retraces, and if this fair value gap hold, then we are likely going to take an entry. So as you can see, this fair value gap has pushed the price down. Price respected this fair value gap here, but let's see how it goes. In this kind of scenario, we can see that price has taken this area. Price has disrespected the fair value gap. Normally, this fair value gap acted as a resistance and pushed this price down. So we cannot draw this fair value gap. Why didn't I draw this fair value gap? Because this fair value gap was used to drop this price. And we see it dropped it to the point that we have a candle closure below this area. So when we have this candle closure below this area, I won't really trust this fair value gap. But if you look closely here, we have a fair value gap here, another fair value gap here that was disrespected. When we see this fair value gap that was disrespected with momentum, then this area is a significant area to wait for our entry. So let's wait to see what happens. Remember, we have a bullish fair value gap here that is acting as a confluence. Let's see if this bullish fair value gap will hold as well as this bearish inverse fair value gap. Price taps into that. As you can see, price comes here and closes above this. But remember, price is still in this our main bigger time frame fair value gap, and likely price has closed above it. So this is still a valid entry from here. If we should take our entry from here, market execution order, place our stop here. We target the middle of this range. This is where I'll set my take profit, the middle of this range. Or can wait for price possibly to know whether price will disrespect this fair value gap. Then I will take a trade on the inverse of this fair value gap. So let me put price to see how it goes. As you can see, price disrespected this fair value gap and is moving forward. Possibly I'll wait, if here should be my entry, I'll wait for a price market reversal into this fair value gap, then I'll make my entry. As you can see, market has moved into this fair value gap. When market has moved into this fair value gap, I'll wait for candle to close above, then I'll take my entry. So we see a candle closure. This can still be your entry. Remember, our draw on liquidity is here. As you can see here, price goes on to this draw on liquidity. So this is how you can use. So this is the best way to analyze a trade based on draw on liquidity. Always check for the fair value gaps that are respected or disrespected. When you look for fair value gaps that are being respected or disrespected, it will give you a clear understanding of where the market is likely to be drawn to. It's not all about knowing where the market is drawn to. It's about analyzing the market context. If the market is bearish, the bullish fair value gaps are supposed to be disrespected, bearish fair value gaps respected. If the market is bullish, the bullish fair value gaps are supposed to be respected, the bearish disrespected. So once you know this concept and apply it in your trading, you will have a higher probability of winning that trade. So it is also good to enter based on inverse fair value gap because it will give you a further confirmation of your entry. Also, there are some other entry confirmations like SMT and the rest, but you should always acknowledge fair value gaps that are respected and the ones that are disrespected. You can also subscribe for further information and also to get insights. Thank you so much.